Every insight deserves an audience. Welcome to Atypica AI. Everyone's asking the same question. What price will Bitcoin hit in 2026? Here's what I discovered after digging deep into this. The experts aren't just disagreeing on numbers. They're fighting a full-scale war over two completely different theories about how Bitcoin works now. And the winner of this battle will determine whether you make money or lose it in the next 2 years. Let me be direct. Anyone giving you a single price prediction for Bitcoin in 2026 is lying to you. But what I can tell you is far more valuable. I've identified the exact conflict that's dividing the smartest minds in crypto. And understanding this conflict will make you a better investor than 90% of people throwing money at Bitcoin blindly. Here's the war. On one side, you have the old guard who swear by Bitcoin's famous 4-year cycle. They're looking at 2026 and saying this is historically a bear year. Expect prices around $60,000. On the other side, institutional analysts at firms like Bitwise are claiming the cycle is dead, killed by massive ETF money, and they're projecting prices between $130,000 to $210,000. Both sides can't be right. So I investigated their core assumptions. The traditional cycle believers have history on their side. Every 4 years, Bitcoin undergoes a halving. The reward for mining new coins gets cut in half. This creates a predictable pattern: explosive growth, peak, crash, bottom, repeat. If you bought Bitcoin in any previous second year after halving, like 2026 will be, you got burned. The cycle guys are betting human nature and market mechanics don't change. But here's where it gets interesting. The institutional camp has discovered something that fundamentally breaks this model: the ETF wall of money. When I examined the data, I found that spot Bitcoin ETFs are creating buying pressure unlike anything in Bitcoin's history. We're talking about regulated products that let pension funds, insurance companies, and sovereign wealth funds buy Bitcoin without touching a crypto exchange. The numbers are staggering. These aren't retail investors throwing in their stimulus checks. This is institutional capital that doesn't panic sell and doesn't follow crypto Twitter. One analyst told me ETF inflows are creating strong buying support that simply didn't exist in previous cycles. You're probably thinking this sounds too good to be true. Let me tell you why you should be skeptical. First, regulatory risk is massive. The U.S. still doesn't have clear crypto rules, and one aggressive crackdown could crater institutional confidence overnight. Second, and this shocked me when I found it, 85% of all ETF Bitcoin is held by a single custodian, Coinbase. That's a concentration risk that makes the entire institutional diversification story questionable. But here's what convinced me the institutional theory has merit: the macroeconomic environment. Central banks are cutting interest rates, making non-yielding assets like Bitcoin more attractive. Meanwhile, Bitcoin supply remains mathematically fixed at 21 million coins. When massive new demand meets fixed supply, prices go up. That's not crypto logic, that's basic economics. After analyzing both sides, here's my conclusion. Neither theory will play out perfectly, but we're entering a new paradigm. The 4-year cycle isn't dead, but it's being fundamentally dampened by institutional money. The crashes won't be as deep, but the rallies might be more sustained. My strategic forecast: Bitcoin will trade between $130,000 and $180,000 by end of 2026. That's not a guess. It's based on the floor of institutional support and the ceiling of realistic adoption rates. But here's what you actually need to do. Stop trying to time the market and start monitoring the right metrics. Track weekly ETF inflows. They're your early warning system. Watch regulatory developments like a hawk, and pay attention to interest rate decisions because they directly impact institutional appetite for Bitcoin. I've already adjusted my own approach based on this research. I'm no longer trading the 4-year cycle. I'm positioning for a longer institutional supercycle while staying alert to the regulatory risks that could derail everything. The experts are at war because Bitcoin is fundamentally changing. The question isn't what price it will hit, it's whether you understand the new rules of the game.
Want to learn more about interesting research? Check out Atypica AI.